Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of Keurig Dr Pepper Inc., ticker symbol KDP. So at the time of recording today's video, Keurig Dr Pepper is trading for $38.69 per share. Over the past year, they're up 9.5%. Over 3 years, they're up at a rate of 12.5% compounded annually. And since the merger that brought these two businesses together, Keurig Dr Pepper has returned 12% compounded annually. In addition to this 12% annual return, the business also pays out dividends. Currently, they have about a 2% dividend yield. Keurig Dr Pepper has not had a lot of volatility between their 52-week low and high. The business is about $3 below their 52-week high and about $6 over their 52-week low. They are a relatively large business. They have a $54.5 billion market cap. For some background about the business, Keurig Dr Pepper operates in the non-alcoholic beverages industry. They are the product of a 2018 merger between Dr Pepper Snapple and Keurig Green Mountain, and Keurig Dr Pepper is the third largest non-alcoholic beverage company in North America, behind Coca-Cola and Pepsi. In addition to the eponyms, the company's flagship brands include 7-Up, Canada Dry, Schweppes, Mott's, and Bai. The company situates itself at different positions of the value chain depending on the segment and the product. It currently reports 4 different operating segments, and it is primarily a brand owner in its beverage concentrates and Latin America beverage systems, as well as for single-serve brewers within its coffee system segment. And the business owns integrated production and distribution operations in its packaged beverage segment, as well as for its K-Cup pods. So the company serves retailers, bottlers, distributors, restaurants, hotel chains, coffee distributors, and end-user consumers. Keurig Dr Pepper was founded in 1981 and is headquartered in Burlington, Massachusetts. So for our fundamental analysis today, we are going to be performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Keurig Dr Pepper based off of their business fundamentals. This analysis is still a work in progress and it's still evolving. It's an opportunity to learn in public. With that said, let's get right into our analysis. Starting off with our first metric, we want their average return on capital over the last 5 years to be above 14%. So the average publicly listed business earns about a 7% return on capital, and over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. We can build in some margin of safety for ourselves by looking at businesses whose return on capital are twice as good as average. So this helps us look for high quality businesses. So Keurig has below average returns on capital. Since their merger, they've been increasing these returns. However, they're still below average. And over the last 5 years, they average just about a 5.7% return on capital. So this is going to be an X to start off here on metric number 1. Metric number 2, we're looking for revenue, net income, and free cash flow growth over the last 5 years. This helps us look at a high-level overview of the cash coming into the business. And this metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric is going to be an X. In this case, these numbers are going to be skewed for 2017 because it was just prior to the merger. So it's just counting Dr Pepper Snapple. Since the merger in 2018, however, their revenues have almost doubled. The merger took place in 2018, so it really didn't come into effect for an entire fiscal year until 2019. However, over that time frame, they have managed to grow all 3 of these metrics. They've grown them over 5 years as well. So this is going to be our first check here on metric number 2. Metric number 3, we're looking for earnings per share growth over the last 5 years. This is going to build off of our previous metric, but here we're taking the perspective of an individual shareholder in the business to see what these earnings are looking like on a per share basis. So over this time frame, Keurig Dr Pepper has again grown their earnings per share. One thing to note is that their earnings have actually grown faster than their earnings per share. So this signals to us that there has been some shareholder dilution over this time frame. Based off of their shares outstanding, the company has issued about 30% additional shares since their merger took place in 2018. So even despite diluting existing shareholders by 30%, they've still managed to increase these per share metrics. Metric number 4 is very similar. We're looking for free cash flow per share growth over the last 5 years. This one is also going to be a check. Over the long run, both earnings and cash flow should be about even for a business. If there's a huge discrepancy here with a lot of earnings versus very little cash flows over an extended time frame, that could potentially be a signal of fraud in a business. However, that's not something we're seeing here. Individual shareholders have seen both the cash flow and the earnings that they're entitled to grow over this last 5-year time frame. So this is a great sign to see here. Through 4 metrics, we've got 3 checks on Keurig Dr Pepper. Next up, for metric number 5, we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that they've generated in the past 5 years. So here for their free cash flows, we're going to extrapolate what their average free cash flows have been for the past 4 years and expand that into 5 years since their merger took place in 2018. So at the end of last year, Keurig Dr Pepper had about $12.8 billion of net debt, and using that extrapolated free cash flow, they produced about $11.5 billion of free cash flow over this time. They have more net debt in their business than their cash flows are able to support. Ideally, we don't want to be investing in overly levered businesses because during economic downturns, overly levered businesses are going to be at the most risk. In the case of Keurig Dr Pepper, given the nature of their business as more or less consumer staple products, it's likely not as risky that they have these higher debt loads relative to some other types of companies, as they do have differentiated products here. And a good sign to see is that they've been decreasing their net debt over this time frame, which likely means that the business has been paying off a good amount of this debt and has been prioritizing debt repayment as one of the ways that it's using its free cash flows. So free cash flows can be used to pay down debt, make acquisitions, reinvest back into the business, buy back shares, or pay dividends. Free cash flows are the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. So while their free cash flows currently don't support their debt load, and this is something that we don't like, so this is going to be an X on metric number 5, this may not be as bad for Keurig Dr Pepper as it would be for other businesses with undifferentiated products. Finally, the big metric of them all, metric number 6, we want their average 5-year free cash flow relative to their total enterprise value to give us a yield above 5%. If they have that yield above 5%, that'll give us a slight risk premium to the risk-free rate. The reason we're using total enterprise value is that it's going to incorporate both their market cap and their net debt position. So this is going to be a more realistic economic picture of the business as opposed to just their market cap alone. And it'll be closer to what the business would be like if it were a private business. Currently, Keurig Dr Pepper has a $67 billion total enterprise value, and using their extrapolated average free cash flows of $11.5 billion over the past 4 years, extrapolated into 5 because of their merger. While it is a little complicated, that means they're producing about $2.3 billion of free cash flow in an average year. So when we divide their $2.3 billion of average cash flow by their $67 billion total enterprise value, that is going to give us an average 5-year free cash flow to total enterprise value yield of about 3.5%. So right in line with the 10-year treasury here for the risk-free rate. This is below that metric we're looking for of 5%. So this is going to be another X here on metric number 6. Here we're looking at their dividend profile. So Keurig Dr Pepper currently pays out about a 2% dividend yield, which is slightly better than the S&P 500. People make mistakes all the time by blindly chasing dividend yields, so it's important to stop to look to see that a business's dividends are well supported by their abilities to produce free cash flows. Over this time frame, Keurig Dr Pepper has more than doubled their dividends, and they've been able to increase their cash flows per share. While this hasn't been huge free cash flow growth, they aren't paying out that high of a percentage of their free cash flows out as dividends. They're keeping this well under 50%. And so it looks like they have plenty of breathing room to potentially expand this going forward into the future if they would like to. Keep in mind that that's not any sort of guarantee, but based off of this breathing room here and what other non-alcoholic beverages businesses have done, it seems like it would be pretty likely that they'd increase their dividends over time. And they're well supported by their cash flows. So that's a strong sign to see here if you're potentially interested in the business, in part because of its dividends. Finally, here we're using a discounted cash flow model to come to a potential fair value for Keurig Dr Pepper. So starting with their current free cash flows per share, which are a little under $2 per share, then using a growth stage over the next 10 years with a growth rate of 5.5% based off of their abilities to historically grow their free cash flows, and then using a terminal stage for the 10 years after that with a growth rate of about 4%. These are historical assumptions, so they would only give us a baseline for the future It's up to you to validate or invalidate these for yourself, and this is likely not going to be accurate going forward. This is just a baseline to help us get a rough approximation. It's up to you as you learn more about the business to understand if this is fitting or not. So with those historical growth assumptions, if you were looking for a 10% rate of return from Keurig Dr Pepper today, it looks like a potential fair value for the business is around $24 per share. So that does not give us a margin of safety in the business's current stock price of nearly $39 per share. Instead, based off of those same historical growth assumptions, it looks like you could only expect about a 3 to 4% rate of return going forward on Keurig Dr Pepper. Keep in mind that this would be including their dividends. Personally, given the nature of their business, I think this is going to be a little low, and this is selling this business a bit short. The big thing to understand with a discounted cash flow model is that it's just like any other model. While this is one of the primary ways of valuing a productive asset, and is what Warren Buffett would more or less do in his head, just like any other model, a discounted cash flow model is totally going to be dependent on your inputs into it. Those inputs are going to determine your outputs. So as you do more research to learn about the business in more depth, you'll hopefully come to a better understanding of the company, and these can help you fine-tune your inputs. So keep in mind that this type of analysis and this discounted cash flow model are not financial advice. They are not a buy or sell recommendation of any security. Before considering any investment, please consult with the properly registered financial professionals. This type of analysis really serves as a holistic beginning understanding about the business to help educate you to determine whether it's worth your while to dive in and learn more about Keurig Dr Pepper in the future. If you're interested in learning about the business, I highly recommend diving into their 10Ks and reading through their earnings call transcripts to get a better sense of the business. You can better understand the opportunities and the risks associated with the business and what potentially lies ahead for the company. And you'll understand how management is thinking about and approaching capital allocation. So if you're interested in learning more about the business, I highly recommend those resources. So in summary, Keurig Dr Pepper only checks the box on 3 out of 6 metrics. Currently, they're earning below average returns on capital. However, they have been improving since their merger. After their merger, they've been growing their revenues, earnings, and free cash flows. However, they have been diluting shareholders over the same time frame. So even with that dilution, their per share metrics are also increasing. Then based off of their free cash flows, it looks like the business is utilizing a bit too much debt relative to their abilities to produce free cash flows. And their average free cash flow to total enterprise value yield is just about in line with the 10-year treasury right now. So it doesn't give us the type of risk premium that we were ideally looking for. It looks like the company's abilities to pay dividends are well supported by their cash flows though. And then finally, using a discounted cash flow model for the business based off of historical growth assumptions that serve as a conservative baseline and need to be checked and validated or invalidated by yourself through further research. It looks like at today's prices, you could only expect about a 3% rate of return going forward on Keurig Dr Pepper, which would include their 2% dividend yield. And if you were looking for a 10% rate of return going forward, you would have to wait for a drawback in the company's share price to about $24 per share. So Keurig Dr Pepper did get below that price in March of 2020. So these things do happen. Personally, I think that type of discounted cash flow model is a bit unrealistic for Keurig Dr Pepper just at first glance, given the nature of their business, and I think it sells them a little bit short. However, I'm no expert on this business. I have not done the work here outside of this beginning analysis of the business. That's not any sort of financial advice, and it's ultimately up to you to do the research and learn more about the company in more depth. As a value investor, you ideally want to learn about a business as if you owned 100% of it, and you want to come to understand all of the ins and outs of a business and truly understand its underlying essence. Again, this type of analysis is not financial advice. It is not a buy or sell recommendation of any security, and please consult with the properly registered financial and legal professionals before making any investment decision. So with that said, that's it for today's fundamental stock analysis of Keurig Dr Pepper Inc., ticker symbol KDP. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Keurig Dr Pepper with me, and have a great day.